Today's program, I wanted to give just a quick introduction to Milton Mueller here, who will be moderating our panel. He'll introduce Eric and Lawrence to you. But Milton is, how can I put this? He's one of the OGs of internet governance. He has a new book out, Declaring Independence in Cyberspace, the third in a trilogy of books about essentially the emergent order around the internet governance over the last 20 to 30 years. And earlier, actually last year, there was an opportunity to partner with the Internet Governance Project that Milton and Karim Farhat, who you'll hear from later, that they are the directors of at Georgia Tech. And it's been a really interesting opportunity to think about the ways in which we can apply lessons from that history of internet governance, from the missteps, but also some of the good decisions made with alternatives to provided governments of the internet, and apply it to new areas, new technologies. So we've done some workshops on AI governance, private alternatives to state-provided governance in AI. And I think we can loop this, broadly speaking, apply some of those same insights to cryptocurrency regulation and governance questions. So this is a really great relationship we've had with IGP and IHS. And so I'm excited to have this conversation today with Milton, Eric, and Lawrence. Lawrence was unable to be with us here. He got caught up. United Airlines had a mass, like 1,000 flights were delayed or canceled yesterday because of, well, I suppose their IT departments heads are going to roll. So he is here with us. You probably can see his picture on your screen. So he'll be tuning in via Zoom and offer some comments as well. So we're thrilled he was able to be here in spirit, if not in flesh. So with that, I'll turn it over to you, Milton.
Thank you very much, Paul. And again, let me express my appreciation for IHS. Speaking of OGs, if I'm the OG of IG, then the IHS is the OG of classical liberal academic support, because they have been around since the 70s, I think, maybe even earlier. But there is really an important form of cooperation going on here between our work on digital governance and the cryptocurrency debates, policy debates going on. And we really appreciate the willingness of Paul and IHS to sponsor this event. So our first panel is going to be about the compatibility of the US dollar and Bitcoin, and some of the interactions between policies that would legitimize or promote digital cryptocurrencies and the fairly serious problems faced by the US dollar in its future. So let me introduce our panelists first, and then I will ask them some questions, and we'll start our discussion. So let's begin with Larry White, who I don't know if he's above me or not, but you can see him. He's a very prominent economist. Everybody probably knows him involved in these cryptocurrency debates. He specializes in monetary theory and banking history. And he is currently a distinguished senior fellow at George Mason University. He also has an affiliation with the Cato Institute, and some time ago he was at New York University. So let's turn now to Eric Alston. Eric is a equally prominent writer and a scholar related to institutional economics. Currently, he's a scholar in residence in the finance division at the University of Colorado Boulder. And he received an MA in economics from the University of Maryland and went on to get a JD from the University of Chicago. So he's really sharp on the law and economics side and institutional economics. So we have some really good people here to discuss this. And let me just begin by kind of setting the stage. So we all know, particularly those of us in the US, we kind of take it for granted that the US dollar is this global reserve currency that everybody accepts. It underpins trade invoicing, liquid reserves, private debt creation, And this, of course, grants the US economy and the US government immense influence over the international monetary system. Um, so the question now is, we have some serious challenges to this special and privileged status, not the least of which is, of course, the growing US debt, which has reached the point where even, well, if our Congress doesn't specifically do anything about it, they're at least talking about it being a problem, which may be progress. So let's talk about what the US's ability to deleverage its debt, let's say by money printing, by restructuring, or by protectionist trade policy, how is that going to influence private currency adoption? And let me begin by turning to Professor White for that question.
Thanks, Milton. Well, happy is not the word, but I am joining you from the fabulous Ramada near the Denver airport because somebody flipped a fire alarm switch at United's headquarters, which caused the cascade of cancellations, which made me unable to join you in Jackson Hole. So on this theme of US dollar compatibility with Bitcoin, I'm going to draw on some themes that are in my recent book, which is entitled Better Money, Gold, Fiat, or Bitcoin, where I talk about the competition among monetary standards. So at the level of monetary standards, you have to say that the dollar and Bitcoin are competitors, and in that sense, incompatible rather than compatible. If you think of them in the role of serving as a commonly accepted medium of exchange and a unit of account. And as is explained in the paper that will be discussed this afternoon by Farhat, Mueller, and Srivastava, money has the properties of a network good. That is, the greater the number of other people who use the same money as you, the more useful that money is to you because the more potential trading partners you have. And so the dollar and Bitcoin are alternative monetary standards, and money markets or the market for media of exchange tends to be a winner-take-all market in the absence of legal restrictions. And we've seen that in cryptocurrency markets, that is where people buy and sell Ether and other Litecoin and other cryptocurrencies. The trading in those markets used to be in Bitcoin, but now it's in US dollar Tether. And the daily volume of transactions in Tether exceeds the daily volume of transactions in Bitcoin, even though Bitcoin has about 14 times the market cap of Tether. So on a recent day, Bitcoin was worth $2.3 trillion. Tether had only 163 billion in circulation, but the 24-hour volumes of transactions were 161 billion for Tether. So every Tether was turning over each day, whereas for Bitcoin, it was only 101 billion. So that's a much smaller fraction of 2.3 trillion. Now, why isn't Bitcoin more popular as a medium of exchange? Because its price volatility makes it a dangerous place to keep your rent money, at least if your rent is denominated in dollars or euros or some existing fiat currency. It would be different if your rent were denominated in Bitcoin, but getting to that world is a chicken and egg problem. It's not in any landlord's interest to denominate your rent in Bitcoin until Bitcoin is a commonly accepted medium of exchange. So it's a problem getting there from here. Both the Bitcoin, though, has a popular use as a savings medium. It attracts hodlers, people who just want to hold on to it and let it appreciate. And both this potential for appreciation and the price volatility are built into the Bitcoin's architecture. It has a pre-programmed supply release schedule. And that means the quantity doesn't at all respond to changes in the market price of Bitcoin. In economics, we call that a vertical supply curve. And that means changes in demand are fully reflected in price and not at all reflected in the quantity of Bitcoin in circulation. We've also seen head-to-head competition between Bitcoin and dollars in countries where the domestic fiat money has performed very badly. So take Venezuela, for example. During the Venezuelan hyperinflation a couple of years ago, we saw more use of Bitcoin as a medium of exchange. Partly that was because the Venezuelan government was trying very hard to suppress the use of US dollars. Once they stopped doing that, once they eased up on the restrictions, it's the US dollar that's taken the place of the Bolivar in everyday transactions. And that's because the US dollar already has an established trade network, and Bitcoin, although it has its uses as a medium of exchange, is not a commonly accepted medium of exchange. The policy implications I would draw from this are that competition among monetary standards, especially if you live in a country with bad currency, is good for money holders. It enhances the welfare of money users by giving them an escape valve from bad currency, from high inflation fiat monies. And even in countries with relatively decent money, with lower single-digit inflation rates, let's say, it helps to be able for the public to switch to a better currency if the need arises. The more sensitive money holders are to the inflation rate, the more careful the central bank has to be to hold on to its customer base. So that may help discipline the central bank not to inflate. So the policy implication is don't tax or restrict alternative monetary standards. Now, Bitcoin doesn't much serve as a commonly accepted medium of exchange. And serving as a savings vehicle, that's fully compatible with the dominance of the US dollar as the monetary standard. Same thing is true of the competition between dollars and gold. As long as gold is just a savings vehicle and not a commonly accepted medium of exchange, US monetary authorities don't need to worry about its price or its popularity. Bitcoin does have a use as a medium of exchange for transactions that people want to route, or is it route, around the current banking system. So Alex Goldstein uses this example. If you want to send money to a dissident group in Belarus, you can't wire them dollars. The Belarusian government won't let them have a dollar bank account. It will stop that transfer, but you can send them Bitcoin. And there's a local market where they can swap the Bitcoin for the local currency they need to pay wages and buy groceries. So Bitcoin has this important use as a censorship-resistant medium of exchange, not a commonly accepted medium of exchange, but a niche medium of exchange for that purpose. Does it have the potential to dislodge the US dollar? Does Bitcoin have that potential? It seems to me unlikely unless the dollar moves into chronic inflation of, let's say, 20% or more. And I picked that figure by looking at dollarization from the bottom up in Latin American countries where the pesos reach high inflation levels. People put their own savings in dollars. They begin denominating the prices of big ticket items in dollars. They begin accepting payment in dollars. But it seems to take fairly high 20% or so and chronic inflation for them to do that. If all the fiat currencies in the world were subject to breakdown, and the fiscal picture that Milton mentioned is one reason to worry about that, Then I think it would be a choice between people switching to a Bitcoin standard and switching to a gold standard. Shouldn't leave gold out of the story. It has a less volatile purchasing power than Bitcoin because it has a more elastic supply. It's not much more elastic, that is more responsive to demand in the short run, but you do get non-monetary gold being converted to monetary gold if the price goes up. In the long run, the supply is quite elastic because gold mines can produce more when it pays to produce more, when the relative price is higher. And gold has actually a larger established base of users than Bitcoin does. There's about $23 trillion worth of gold above ground. About 5.2 trillion of that, according to the World Gold Council, is in monetary form already, that is bars and coins, versus a little over 2 trillion in Bitcoin. And in practical terms, central banks, especially China and India, have been stocking up on gold in recent years as a hedge against dollar inflation, not stocking up on Bitcoin. So that's what I had to say about the compatibility or incompatibility between the dollar and Bitcoin.
Thank you, Larry. So just to follow up a little bit, so you think the U.S., the conclusion I would draw from your statement was that that both gold and Bitcoin would serve in some way as a haven for if the U.S. continues to inflate the dollar, and that gold might actually be more important than Bitcoin.
Well, it's hard to say from my armchair what would happen in that scenario, but let the market sort that out. Each medium has its advantages. Bitcoin, in that it's the payment network is more sophisticated right now than there is digital gold, but the people providing it don't seem to think of it as a payment medium. They let you store it for free. I'm talking about Gold Tether or Pax Gold, but they charge you for transfers. So they discourage its use as a medium of exchange in that way. If somebody set up a gold denominated bank account system, that would be a better competitor as a medium of exchange. But that of course is currently restricted by banking laws.
All right, so let's go now to Eric. I want to focus you particularly on a couple of questions that go into a bit more detail. So there are these recent policy proposals for a Bitcoin strategic reserve and a sovereign wealth fund, which may or may not have anything to do with Bitcoin, but how do you think those developments affect the US dollar and Bitcoin?
So I think it's first very important to distinguish between the numerous reasons that central banks have for reserves versus sovereign wealth funds properly construed. And so for me, I do take a dimmer view of the US having a sovereign wealth fund because it feels like maintaining a savings account alongside, increasingly large credit card balances, which is the standard financial advice is pay down your credit cards before you have, a low interest rate savings account. And so to me, to have a sovereign wealth fund on the side, to me, the traditional sovereign wealth funds that I understand are Norway, Saudi Arabia, places with serious fiscal surpluses that say, what can we do with this over the long run for our society? I wish we were in a position of net, fiscal surpluses, but as our introduction already indicated, we're pretty far from that. And so that being said, I think an interesting question, in addition to the competitive margins between Bitcoin and the US dollar, are margins of complementarity that will come up later throughout today, and enjoyed your paper for later, so I won't foreshadow too much of that. But what I mean is Bitcoin is exploring on the Lightning Network embedding access to US Tether. And so this could enhance the use of that network on important margins because you'll have access to dollar-denominated tokens that transfer on the Bitcoin network directly. And so I think there are interesting ways in which Bitcoin is actually complementary to certain US dollar policy objectives, and therefore, as a strategic reserve for the Federal Reserve, I could see some functional benefits to, having Bitcoin exposure, although a lot of this is signaling, which is to say the Trump administration coming in is signaling a more friendly approach to cryptos writ large. And so possibly one of the most significant outcomes of the Federal Reserve, assuming, a large Bitcoin reserve, if you will, you name the government entity where that would actually be housed, that to me would probably be more important as a signal than it would be for the strategic use of the government itself. But this administration is clearly saying we are open for business for crypto, and I think that would itself have a material impact on Bitcoin's price. And we saw it, closely with the announcement of, hey, we're exploring a Bitcoin strategic reserve. There was an instant price bump. Whether or not, that's a durable price bump, I think would be a function of the government's intent to acquire a significantly larger amount. I know the initial proposals surrounded kind of Bitcoins that were forfeited in various criminal seizures, especially by the DOJ, as opposed to outright going out and buying a bunch of Bitcoins on the market. I would love to see sort of the price effect on Bitcoin denominated in US dollars if the government were to announce a deep intent. And just as a kind of final closing thought, this is the first year that I've sort of seen Bitcoin begin to display the characteristics of truly a hedge or a competitor to the US dollar. What do I mean by that? Prior to this, it's been a risk-on asset fundamentally. So, softer monetary policy environment, people risk on into these assets, including with the stock market. But we're beginning to see decreases in Bitcoin's correlation with stock market prices and jumps in Bitcoin's price associated with negative inflation announcements in terms of the CPI indicators. And so this is still early relative to the well-established role of gold as a hedge, but it is interesting that we're beginning to see for the first time sort of a weakening of that correlation, which I think is indicative that people are beginning to see Bitcoin potentially as a hedge against US dollar instability, especially on the inflationary margin. It's still a pretty risk-on asset, though, in terms of Bitcoin prices tumbled with sufficiently severe tariff announcements alongside broader market forces. And so to me, the evidence is a bit mixed, but this is the first year that we're beginning to see it assume that kind of competitor role.
Let me delve into that relationship, competitor versus complement, because both you and Larry kind of touched on that. So Larry came out pretty forthrightly and said, they're competing forms of money. Earlier, you said there was a complementary relationship between the international role of the dollar and its ties to Bitcoin. And then in the end, you also said it's serving as a hedge and therefore is kind of a competitor. But both of you can address this, but let's just start with you, Eric. What do you think? Is it inconsistent to say it's both a complement and a competitor, or is that a reasonable way to approach it?
So the reason I brought up the stable coins is if as predicted by the kind of the taproot folks who are pursuing the use of stable coins on the subsidiary network to Bitcoin called the Lightning Network. And so that's a network that offers lower fees at the cost of a modicum more trust in certain intermediaries within that process, but it's not like, oh, trust us like the traditional banking system. So in that sense, if it increases dollar sort of penetration into all of the contexts in which Bitcoin transactions are currently being used, I see that as complementary, consistent with the points you make in the paper we'll be discussing later about how stablecoins can actually enhance dollar dominance. But the point I noted, which was CPI announcements that are sufficiently outside the bounds of expected inflation this year have resulted in pretty significant ticks upwards in Bitcoin's price. And so for me, that is potentially a competitive role, but I don't see, I wonder, as you alluded to at the beginning of your remarks, about how long can this train continue? And you cite Lynn Alden's Broken Money, and she likes to say, nothing stops this train, which is when referring to the sort of increasing debt levels that we see regardless of the party in control of government. And I am a firm believer in the actual net benefits of competition writ large. And we don't seem to be able to self-impose fiscal discipline given the privileged and exorbitant privilege, as it's often called, of the US dollar as the de facto global reserve currency, leading to just, seemingly unlimited demand for dollar-denominated debt instruments, treasuries, being the most important class of those. And so, to me, if we're never going to impose this discipline upon ourselves, in an interesting way, the strength if you believe we are stronger through competition, imposing fiscal discipline might actually in the long run make the dollar stronger, or at least provide a countervailing force as against this relentless march towards more and more dollars in circulation, whether directly or those through issued by the federal government to debt finance its public policy objectives. And so, yes, that's a directly competitive role, but in the long run, if it actually induces needed fiscal discipline, isn't there an argument that there's a certain complementarity there as well?
I would agree with that, but Larry, what do you think? Complement or competitor or both?
Well, I agree with Eric that if the ability of people to switch when inflation gets too high into another currency helps to discipline the Fed, then that's a complementarity role. That is, but the question is, will the Fed be able to respond to those market signals, or will they be dominated by fiscal policy? Will they be told and compelled to monetize debts? And the future of deficit spending does not look bright. I mean, the deficits are projected to get bigger and bigger, and the national debt to rise per dollar of GDP into the indefinite future. So that's the trajectory that needs to be changed if we're going to avoid monetizing deficits in the future. But we've already, I would qualify the statement that there's an unlimited debt for US Treasuries. We've seen the yield that the market demands of 10-year Treasuries go up in recent years. So it's around 4.5 today, which is about 2 percentage points above the inflation rate of 2.5. In years past, it was closer to 1% difference. So the market seems to be more skeptical about the future of inflation. And if you look at the markets for inflation index bonds, they are signaling projections of 2.5% inflation for the next 5 or 10 years, whereas the Fed's official target is 2. So there's a great deal of skepticism in the market that the Fed will reach 2%. But if we can hold them to 2.5, that's better than going off the rail completely.
And I just would like to add a book I love to assign to undergraduates in my financial institutions courses is entitled Fragile by Design. Calomiris and Haber are the authors of that one. And the point they make is an important one that makes future dynamics that we're describing more uncertain. It's a simple one, and it follows from a close read of a lot of the history of central banks and fiat monetary issuance. But their thesis is that the objectives of the sovereign have never been extricable from fundamental monetary and banking arrangements in, market societies. And so the big question is if
There have been some exceptions.
yeah, fair, including, I'm a big fan of your work, Larry. So there are definitely private banking solutions as well as private currencies that are important historical examples, and their treatment is often, to me, highly inaccurate, if not just awful, in the kind of predominant financial and monetary literature. So point very well taken. But the objectives of the sovereign when it comes to threats to their own fiat issuance, especially when it bears on fiscal policy objectives, are, are wrought in policy choices themselves. And so if Bitcoin were to more effectively discipline the fiscal profligacy of the sovereign, by my read, the sovereign may not just take that lying down, as it were. And so the big question is, the more effectively it could come to compete with the US dollar, what might be policy responses of the US government in that future date? I do think there's some measure of protection, which is an unintended consequence of the IRS designating Bitcoin as taxable property, is that it also probably is construable as property that's protected against unlawful or, unjust government seizures without due process and just compensation. And so to me, in an interesting sense, the benefit of it being taxable property is they can't simply ban its use given the level to which it already is existing within our economy, including in our capital markets with the ETPs that were approved earlier this year.
Can either of you conceive of a situation in which the major world governments, I'm thinking US, China, maybe the Europeans, decide, hey, things are kind of going Bitcoin's way, so we are going to become buyers, setting in motion a competitive dynamic in which the states compete with each other to try to acquire some kind of controlling capability in the Bitcoin network. And how do you think that would work, or could it work, or is it unlikely?
Well, we've already seen El Salvador embark on a Bitcoin purchase program. And kind of unfortunately for the precedent it sets, they've made a profit. Price has gone up since they bought it. And it seems to me foolishness to have governments, especially governments that have negative net worth, creating so-called strategic Bitcoin reserves. Best thing for taxpayers would be to sell any Bitcoin they've got, and then they don't need to collect quite as many taxes. But you may see some governments acquiring Bitcoin as an investment. I think Bhutan has a strategic Bitcoin reserve as well.
I think it's important to distinguish between smaller nations like, El Salvador or Bhutan versus China or the United States. Although the El Salvador example is also telling in terms of the response of, government institutions, and in this case, the IMF, saying, would you like continued financial assistance? If so, we want you to scale back many of the most sort of stringent policy requirements surrounding Bitcoin. And so to me, the sort of status quo incumbent international monetary order isn't going to take this lying down, so to speak, when it comes to designating Bitcoin as, as legal tender within a particular society. And so I do think, though, that China's perspective with respect to the Bitcoin network, I view it as even less kind of well aligned than that of the United States, which tends to preserve some modicum of economic and financial liberties tethered to the individual in particular. And For China, a network that you cannot shut down, that you cannot seize assets from, that you cannot force the divulgence of additional payment metadata, or you name it, it is, to me, reasonably antithetical to their, the principles by which they govern their society, which don't sort of cherish the rights of the individual to the extent that the United States and other market-oriented orders do. And that being said, it is interesting to note that China is among the countries with the highest uptake of cryptocurrency usage in the world, which could well be an indication of the fact that their citizens might hold dear those same economic and financial liberties that I'm describing, even as the government may be unwilling to give it to them. But to me, the position of more autocratic governments is, to my read, it more delicate when it comes to these networks that you can't subvert through a single centralized point of failure or kill switch.
I mean, this points to the privacy and the privacy preserving role of Bitcoin, the censorship resistance. So China has outlawed the use of Bitcoin because they want everyone to have a bank account that they can surveil, either in a state-owned bank or in a central bank digital currency. And so Bitcoin is antithetical to that. The people using Bitcoin in China have to be deep underground to avoid detection. So it's not going to become a popular medium of exchange. The Chinese government has succeeded in driving it underground, but people who want to preserve some modicum of privacy from the Chinese government are using Bitcoin for that purpose.
Yes, the economic liberty that I think the Chinese are interested in mainly is the ability to do capital flight, basically, that if they are feeling uncertain about the situation in China, they want to be able to move their money out, and that is precisely what the Chinese can't allow to maintain the kind of centralized power that they have. So there is kind of a structural contradiction between this globalized digital cryptocurrency and with an independent infrastructure and the Chinese national policy. But again, the question was sort of, if they decide that that game is on, what would it do for major treasuries, national treasuries, to be competitively acquiring Bitcoin shares, so to speak? Do you think the private currency network is resilient enough to maintain its independence in that regard, or would it sort of like something that we've seen with the internet begin to fragment in certain ways and become a geopolitical plaything?
I mean, in terms of the network's technical capability to satisfy that demand, I think it's quite strong, but another margin of volatility, in addition to the vertical curve that Larry was referencing earlier, was if you have enough large holders on any of these networks, the effective circulating supply is much lower than even the cap were it to be ultimately reached, or the number that are out there today. So if only 5% of Bitcoins are held by people who are willing to sell them or transact in them at any given moment in time, a much smaller, buy from a treasury in Bitcoin can have a much greater magnitude effect on its price as a function of most of it not being circulating. And so I have heard in a variety of cryptocurrency communities, Bitcoin included, a skepticism of large institutional investors moving in and sizing up in terms of their crypto portfolios, again, including Bitcoin. And the question becomes, what might network dynamics look like if 80% of the holders were actually, government treasuries around the world? To me, that's a really fascinating question. And yes, if you held that much, your choices with what you did with your Bitcoin would have deep implications for the value of the network or the value of the token on the network itself. And so for me, it's not to say, given the technical resilience of the network, that there's nothing anyone could do, although I think the cheaper route would probably be, given Bitcoin's current prices, could be to try to command a server farm or the world's largest server farm if you were actually wanting to take it down. Instead, what I suspect would happen in a world where a lot of treasuries had a lot of Bitcoin, their use of that Bitcoin would itself reflect their geopolitical motives, and those would be, to at least some limited extent, reflected on the network itself.
I think we can draw some instruction from the way central banks treat their gold reserve holdings. And I mentioned that China and India have been acquiring more gold in the last 10 years. They tend to just sit on it. It's not used in international transactions anymore. It's really an anachronism for central banks to hold gold. But when they buy it, they just sit on it. And they're a large share of the monetary gold. There's something like close to 20% of the gold above ground is held by central banks. But they're not sources of volatility in the price of gold because they're not buying and selling it. They're not trying to anticipate price movements or speculate in that way. And if they behave the same way toward Bitcoin, it would neither increase nor decrease the volatility of Bitcoin's price.
Okay. Some fascinating questions. We're just touching the surface, but do we have any audience questions?
Maybe I'll make a pitch here. Yes. So those of you watching online, feel free to submit questions in the chat and they'll make their way up here to us. What I can also, I think for now though, why don't we just open the floor to those who are in the room for questions?
Okay. Hello, my name is Linda Nyang from the Global National Security Institute at USF. I had a question about the aspect of surveillance of transactions. I think from my understanding that anytime you have a transaction using Bitcoin, you can monitor on the blockchain. We can't stop the transaction once it goes, but I think law enforcement, for example, they use that to monitor any type of unusual activities. Wouldn't that also be a benefit for authoritarian states like China? So wouldn't they want to accept Bitcoin?
I mean, it's certainly been a benefit for enforcement, including in the United States. That being said, I think it can be oversold in terms of the traceability does require some measure of sophistication. And so I think for governments with low enough enforcement capacity, they're not in a better position simply because it requires a reasonably high capacity government. And so setting that, if you're positing though that the government has enough capacity to enforce, I do think it's often a misunderstanding that the pseudonymity of your wallet address actually makes your transactions anonymous. Instead, you need very, very good digital hygiene to not have your wallet address either linked to an IP address that makes you identifiable as the likely owner of that wallet, or even more saliently, the off-ramps from Bitcoin use are very clear in most instances. And so I do think that there are major enforcement benefits that accrue to the transparent nature of these networks that are not how most payment networks behave in practice, given existing financial privacy protections. And so you're right, there could be a margin by which China would like that, but they're also trying to deploy a central bank digital currency that would definitely have all of the transparency, all of the enforceability benefits that you're describing, as well as many other benefits, which is tied to a legal Chinese identity and the ability to completely freeze any wallet using the Chinese central bank digital currency, which the Bitcoin network by design can't freeze anyone's wallets. Although the upcoming quantum fragility debates, to me, are a very interesting nod towards to what extent will the network go to seemingly subvert property rights, at least on one margin, to protect the benefit of the network that it provides itself, which is these old wallets are under a quantum fragile standard and they need to be migrated in some way. Otherwise, someone can steal them once we develop quantum capabilities.
Thanks everyone for being here. This has been a really enlightening panel. Chris Land, I work for the U.S. Senate, Senator Cynthia Lamas. Got a couple questions. The first is just kind of a macro question. If you had $1 million and you wanted to buy $1 million worth of reserve assets, would you buy Bitcoin or gold, and why? And also think about, the next 20 years and, how both markets are likely to evolve. And then the second question I have is, my boss has proposed ordering the Fed to revalue their gold certificates to purchase a certain amount of Bitcoin. What monetary policy effects would that have on larger economy if those gold certificates were properly valued to the current market price? Thanks.
That's actually a difficult question to answer because legally the Fed does not own the gold, although it appears on their balance sheet. Legally, it belongs to the Treasury, so the appreciation would be added to the Treasury's account. I'm not sure it makes a lot of difference, but if the Treasury then decided to spend this windfall on Bitcoin, that would be a Treasury decision. And I guess I'm done.
No, I'll take on the inherently speculative question by somewhat equivocating, which is, absent more information about the future, I might go 50-50 split between the two. I was recently in South Dakota talking to someone, at a rock store, and they were clearly, obviously motivated by valuable physical tangible objects at a kind of fundamental level, and they were like, oh, you're into these cryptocurrencies, let's talk about them. And they were clearly at least favorable to gold relative to Bitcoin, simply because they were like, the Bitcoin doesn't actually exist anywhere, and it's very hard for people that index, especially on physical cash, let alone on like gold bullion or gold coins, for them to be like, this digital figment can actually be similarly valuable. And the way, I emphasize to my students, I'm like, almost all of our transactions are just us coordinating over the exchange of digital figments. It's just a difference in preferences over the governance mechanism for the exchange of those digital figments that is making the difference. But I do think that those who prefer physical cash or physical gold, on one level, have a strong argument, which, increasingly anything with a computer in it, I think, is likely to be subject to remote control, at least vis-a-vis certain government authorities. Cars can be shut down remotely. Your cell phone provider can shut down your cell phone. It probably, if I dug into it enough, I'd realize Apple could shut down my access to this computer with a click of a button. But all of that is required for me to communicate with the Bitcoin network in order to access that as a store of value. And so I do think that there is an important grain of truth to the kind of those who prefer physical cash and physical gold, simply because if it's in your hand, it's in your hand. And accessing these digital currency networks requires internet connectivity through devices that, if you're decided to be a persona non grata, and I'm generally, I think most of our government's decisions are legitimate, and so I'm not all law enforcement is evil, to be very clear, but I also think they make errors and sometimes are very politically motivated, such that I understand why some people don't want all of their eggs in a network basket that is effectively subject to their ability to communicate over the internet, something I'm not sure we can just unilaterally take for granted as individuals in this day and age.
Let me say a little about the reserve question. If we're talking about a federal government reserve, like a strategic asset reserve, that seems to me to be foolish. federal government should not be investing in speculative assets on behalf of the American public. Let members of the public invest in what they like. If you're talking about as an individual, what should you save? In what form should you save for the retirement? Well, I'm not a registered investment advisor, but a few years ago,
I was
had
going
a
to give
win-
that disclaimer on
Yeah.
everybody's behalf. I didn't want to, with somebody from the government here, I didn't want us to.
A few years ago, I had a windfall that I split evenly between gold and Bitcoin. And the Bitcoin part of the portfolio is now bigger than the gold part of the portfolio.
All right. Any other questions? Yes, Suyash.
Yeah, thank you for this panel and discussion. So I think we have been discussing about US dollar compatibility and with Bitcoin, and we're trying to argue whether it is competing or it's complementary. I want to talk about US economy and Bitcoin, not just the dollar in the sense like, and especially since this new administration, we have been seeing at least for past 4 or 5 months, the way S&P 500 is rising or falling, the Bitcoin is reacting in the same manner, whether it's with tariffs, whether with new policy changes. I feel like it is more dependence at this point in time. It's not, I don't see Bitcoin as fairly independent of the way US economy or stock market is reacting to. And it's much less about global factors. I remember back then, like it is a couple of years ago, when China said, hey, we are going to ban this thing. Then Bitcoin fell. But I don't see this happening with external economies reacting behavior, causing Bitcoin decline or increase. More of US economy itself or Bitcoin, they're becoming interdependent. What are your thoughts about this?
I mean, I think there's a lot of truth to that. And the points I was making about initial or the first observability of hedge-like responses with respect to CPI price data releases is a relative statement, which is prior to previous periods, the strength of the connection you're correctly noting between our, how our stock market's doing and how Bitcoin's price is doing, that strength is weakening, even though that relationship, I would say, is still present. The example I gave was the tariff announcements, and markets tanked and Bitcoin price tanked, pretty much in lockstep. And so I think it's hard to disentangle within such a complex system where the dollar already has such a global role and US capital markets already have such a global role in ways that are bound up in that same dominance of the dollar, which is to say, I've talked to a variety of foreign institutional and individual investors, and some of them are sympathetic to the argument that the reason that foreign investors play in US stock markets is a blend of debt and equity strategies, which is if you want dollar exposure, a diversified dollar exposure is in US equities as well as US debt instruments. But it's kind of weird in the sense that they may not be buying a stock because of their belief in the relative outperformance of that stock. And that's certainly the case if they're buying a dollar denominated index fund, getting you exposure to the entire S&P 500. And so given the role that not only the dollar and treasuries, but also dollar denominated capital instruments play in investment strategies the world over, to me, it is very early days to say, Bitcoin is a fundamental competitor. We would need that many equity instruments denominated in Bitcoin for it to be playing a meaningfully competitive role in the context I'm describing. And so in a sense, I think you're right that Bitcoin will continue to reflect US economic outcomes to a greater extent than US economic outcomes reflect Bitcoin outcomes, and so are Bitcoin, dynamics. And so to me, that is certainly a point well taken, but the fact that we're seeing it move, against inflation is, to me, early indication that some people are viewing it as a hedge. And this is, to my mind, the first time we've seen that since the network's inception. And so I think that's notable, notwithstanding the extent to which, are we talking about a tail or are we talking about the dog of the US economy, as it were?
I just want to add, there is an academic literature studying correlations between Bitcoin returns and returns on other assets. And what they found is that there's very weak, if any, correlation. But that's subject to the academic publication lag. So all the data that those studies are based on is 3 or 4 years old. Whether things have fundamentally changed in the last 2 or 3 years, all we have are anecdotes, really. So it's hard to say.
I just want to pop in here with the way Eric was talking about the relationship between the Bitcoin economy and the US economy is something that plays out in internet governance as well. So if you tried to disentangle the internet economy from the US, what many adversaries in the world complain about is that the internet kind of is centered in the US, and that is true even to the extent to which we have, given up control of the internet registries, the IANA, but if you look at the internet service provider industry, the software industry, the platforms, the economy that revolves around internet connectivity, it's very dominated by the US. Of course, just as we were like 80% of the telecom market in 1960, that's diminishing as the rest of the world develops. But I think that as the digital economy sort of globalizes and becomes things become more digitized, I think you're going to see that connection, close correlation between the US and Bitcoin decline as well. Karim, yes.
Thank you, Karim Farhat with the Internet Governance Project. I wanted to go back to Chris's question, and hopefully this is not too jarring, just switching back, because this is a very important proposal that got a lot of attention, and we have very deep thinkers on the topic, so I think it's worth just going back to some of the points that were made. So Larry was saying that if the gold is revalued, the gold certificates, if they're revalued by Congress, then the Fed won't get the benefit of that, but Treasury will. Eric was mentioning the value of signaling, and I wanted to ask just generally, if this happens, what happens because, when we're in a situation where we signal something to the world where these gold certificates are now worth $900 billion, do we trigger some kind of game theoretic race? And if the bill doesn't pass, what happens with state legislation? Because we've seen a lot of action at a state level where, we're starting to tie pension funds to Bitcoin. We're starting to mine Bitcoin perhaps with state resources. I don't know. But what does that do to the relationship between the states themselves and the Federal Reserve System, especially when we have now, I believe it's 10 out of the 12 Federal Reserve banks are technically insolvent. So what happens there if we were to speculate on the long term? So first is the Bitcoin strategy reserve proposal. What does that signal to the rest of the world? And second, the relationship between the states and the federal government. Thank you.
So with respect to states, I mean, I think it was yesterday or sometime this week that now retirement plans can get exposure to crypto. And I do think generally restraining the classes of investments that retirement managers can vest those that they're representing those assets in, I don't think that that's an inherently good thing, just because if you need to posit certain deep accountability problems or just misjudgments made by investment managers if they want to get exposure to an asset and they're prevented from so doing. And so I would view that as a good thing. I would also defer to Larry's take as to the implications of hey, we need to revalue these gold certificates, even though the benefit due to the relationship between the Treasury and the Fed would be likely to accrue to the Treasury itself. I don't feel quite equipped to speculating about the dynamics that emerge therefrom, but I suspect Larry has thoughts.
Well, it's true the Federal Reserve System is insolvent, and that's because they suffered a lot of duration risk. They have long-term treasuries that are paying them less than they are paying banks for their reserves, right? They're paying like 4.5 on reserve balances, and their portfolio is a mix of maturities, but it's earning less than that. It's earning something like 2.5 or 3%. So that was a result of them getting more involved in credit allocation and trying to change the relationship of long-term interest rates to short-term interest rates, a so-called twist operation, where they were buying long-term assets in order to try to raise their prices and lower their yields. But really, the concept of the Federal Reserve being insolvent, it doesn't have much practical traction because they have liabilities that can't be redeemed. They never have to pay their debts. Right? We count Federal Reserve notes and we count bank reserve balances on the books of the Fed as liabilities, but they never have to be paid. So the Fed goes on being insolvent. It can still meet its payroll by just putting the money, creating the money that needs to put in the bank accounts of their employees. And so I don't see revaluing the gold, even though it would bring the Fed closer to being solvent on a book value basis, having much real impact on the monetary policy decisions that the Fed makes. If the Treasury goes out and buys Bitcoin, the question was, what kind of signal does that send to the rest of the world? I regard this whole idea of a strategic Bitcoin reserve as just kind of a sop to Bitcoin owners. And I was quite disappointed to see the Bitcoin Policy Institute, which used to advocate on behalf of the civil rights of Bitcoin owners, not to be interfered with, start to support this measure, which is an attempt to get the federal government to bid up the price of Bitcoin for the benefit of existing Bitcoin owners. That doesn't seem to me to be a very proper use of the federal government's powers. It's not their job to reward owners of some assets versus other assets.
If I may just follow-up question, Larry, very fair critique on Bitcoin Policy Institute. We can talk about it at a later session, but I wanted to go back to the notion of signaling that, again, Eric first touched on, and highlight the fact that the Fed Reserve System, aren't they still passing these gold certificates amongst themselves as a way to keep their ratios?
No, they
don't
play
do that?
absolutely no monetary role. They're just relics on the Fed's balance sheet.
Okay, so they're not swapped among the member banks anymore at all?
No.
Okay. So the value of signaling here suddenly dwindles a lot. So, okay, that's an answer to my question.
That's great. Well, thank you all. That was a great conversation. And we'll keep the momentum going in about 10 minutes. We're going to take a short break here and then reconvene on the hour. And for our next panel, we'll have 4 folks showing up. And Karim, you can pick up the mantle there that you've left off with that final suite of questions. So yeah, quick break for the webinar. It's the same link. You can just stay on, and we'll just come back when it's time. All right. Thank you all.
All right. Well, we're in the second session here. My name is Karim Farhat from the Internet Governance Project. And I have the privilege today to have with me Matthew Ferranti, who has a PhD in economics from Harvard and is affiliated with the Bitcoin Policy Institute. We have Suyash Gupta, who's a computer scientist at Oregon University. And last but not least, Troy Cross, who's a philosopher from Reed College. So it's a very interdisciplinary group here. And we're going to be hopefully not talking at cross purposes. So what I'll try to do as a moderator is exercise my prerogative and trying to force us to speak as plainly as possible so we don't talk over each other, because it's a complex topic. And the title of this second session that we have here today is Bitcoin Governance and US Government Policy. And the way we're thinking about it is this 2.2 now $trillion asset that we're debating is starting to become really critical to a lot of functions in the economy globally, but also in the United States. And we're still at the early stages, but it's starting to have the attention of mainstream economists, central bankers. A lot of people are studying and researching this. So where we come at this at the Internet Governance Project is we study networks and governance procedures, institutions. So what we were hoping to discuss in this session is some of the governance challenges that Bitcoin faces, of which there are some that some people may debate are a little trivial. We were discussing the op return policy earlier. Others that Troy has highlighted and really kind of sparked my my muse for this session, which is the governance challenges having to do with how the computing power of Bitcoin is distributed among miners that are selling their mining services to mining pools that tend to have large economies of scale and concentrate a lot. And with that, I wanted to start with Troy by asking a very general question, which is perhaps you could lay out some of the dynamics that have to do with the concentration of mining when it comes to some of these mining pools that we're dealing with. My understanding is we have an asymmetric duopoly going on between the US and China. Perhaps you could start by elaborate a little bit on this, and we'll take it from there.
Yeah, well, thank you, and thanks for having me. If I can go back to the origins of mining, in Satoshi's white paper, every miner was a node and every node was a miner. When I first started running Bitcoin software, there was just a button for mining Bitcoin that you pressed. And so mining was as decentralized as node running, which was also as decentralized as using. It was all the same. But these activities became separated as mining became a specialty, using specialized equipment, first graphics cards and then application-specific circuits and ASICs, which are designed only to run Bitcoin, and economies of scale for mining as an activity kicked in. And whereas I mined with two machines in my basement, or first of all just on a laptop, I could not compete after a while with a dedicated mining operation that used a large facility where they bargained for better prices on power, better prices on the supply of their machines, had sophistication in their software that they used to control those machines. It became a special enterprise and therefore became benefited from scale. And now the facilities are enormous. Hundreds of megawatts of power used at some of the largest facilities. And they have dedicated repair personnel. They have their own pools. They have proprietary technology on cooling. So all of the features that make any business enterprise more efficient at scale work for Bitcoin. And what I point out in that Bitcoin Magazine piece is, in some ways, it's surprising there isn't just one Bitcoin miner in the world, given the intrinsic nature of Bitcoin, because it's fungible. There's nothing that one manufacturer of Bitcoin can do with their Bitcoin. That, like, we're in Portland, we like to make artisanal, bespoke, Portland handcrafted Bitcoin. But the Bitcoin are the same everywhere, so you don't get any advantage that way. They're free to ship anywhere in the world because it's just a matter of moving numbers on a ledger, global distributed ledger. So there's no problem with shipment. And so there's nothing really to stop the economies of scale except the distribution of power, of energy. And that's what that piece is about. Energy is highly localized around the world. And anyway, that's one kind of that's how we got here to largely centralized mining facilities. And the risk of centralization is that if the hash rate of the mining network is under the rule of some particular legal regime, if 51% is under that legal regime, then the government could not only forbid certain transactions, certain addresses from transacting on the network, but also could orphan any blocks that include transaction from those addresses, or just order miners not to mine on top of any forbidden transactions. That's the sort of real threat. If the U.S., let's say, were to just forbid miners from including transactions from North Korea or something, that would not really threaten the permissionless and censorship resistance of the network, because those transactions would just get in through some other miner. But if the US said, hey, all of you miners, you can't mine on top of any chain that contains a transaction from one of those addresses, that would mean if we had 51% of the hash rate in the US, let's say, that would mean those transactions could not get onto the network, and Bitcoin would no longer be censorship resistant. That's the vector of attack that I wrote about.
Would be killing the goose that lays the golden eggs. Is that how you framed it?
I don't know if that's fully appreciated by everyone, but it obviously would be and should be appreciated by everyone. There's another centralization vector for mining that comes through pool centralization. Right now we have two pools that are roughly half of the hash rate, and we don't really know whether those two pools are collaborating, or they could in principle. And then the pools could do something similar. Less threatening, because we can always point our miners away from those pools if they misbehave. But that's another vector, and completely separate and less worrisome to me than the vector of where the hash rate is itself.
So to sum up to this point, we have large economies of scale that tend to concentrate the mining power, but that goes against some of the decentralized nature of energy, how Mother Earth just distributes resources around the globe. And there's also the value of decentralizing the network itself in terms of where the miners are located and where the nodes are located, which are not necessarily the same, obviously. So Suyash, perhaps this could be where you come in, but I wanted to ask you if you could explain a little bit more about the Byzantine fault tolerant system that we're running on Bitcoin and the importance of having this network be genuinely distributed, and whether you think that a 15.1% attack would unfold the way people typically think. Is it a hard barrier that will be reached, or is this a threshold that could, if temporarily, if not enough, there was some information asymmetry, not enough people knew about it except the two dominant mining pools, could we get past this happening without the Bitcoin network, the value collapsing, overnight?
Yeah. First, thank you for inviting. As a CS research and faculty, I think it's very rare for us to interact with folks like you, work on public policy and philosophy. And I think it's interesting to see a different perspective. And I think to start with, I think the important question which you said is like, what is Byzantine fault tolerance? And like for people like me in CS, we have viewed whether it's Bitcoin or it's other crypto systems, or beneath the skin we see every one of them running a consensus. And what we call this consensus Byzantine fault tolerance. It has several flavors of it. I think I worked on different flavors of it over the past, and I think what interests the community about Bitcoin is its proof of work consensus. And I think in a very simple layman terms, what is proof of work? Essentially, the idea is that there is a puzzle, a complex puzzle, which everyone is trying to solve. And the idea is that also makes Bitcoin unique in the sense is the way it adopted proof of work is that anyone, anywhere can start a Bitcoin client, and they can join this network, and they can pick up a bunch of transactions from the mempool, and then they can package those transactions, and then they can try to solve this puzzle. And whoever solves this puzzle first essentially gets an opportunity to propose a new block. And then once that person proposes a block, now everyone decides whether whoever receives this block, they'll try to join this chain. And essentially, we have this theory of longest chain. And I think everything what I have summarized, that we can go into more details of it, but I think in general, the idea is that someone needs to show that they have done some work essentially. And I think that also essentially brings to what is the security guarantees of Bitcoin essentially, is because you cannot just forge a block. You cannot just say that, hey, I have created a block. What you need to do is that you have to present this proof. And whoever is able to create this proof, they can show that, yes, see, I have created this proof. And now you all can believe that I have created the block. Now, centralization is clearly a risk to all of this thing. It's in the risk because the way Bitcoin was viewed, and I think it goes back to what Troy was saying, that it has been viewed in a scenario where anyone can join, and it's sort of a decentralized system. Anyone wants, they can participate. Now, the moment we have this centralized nature, essentially we are trying to say that there is one party or basically one pool or maybe one organization who has sufficient power to essentially, and in this case, sufficient power is like 51% power, hash power. And what it can do is that now it can create the blocks whatever it wants, essentially. Or it can take your existing block and it can even change it. And that essentially leads to something called a double spending attack, where the whole idea is saying that, hey, I can reuse the same a resource 2 times or multiple times. So centralization is clearly at a is very disadvantageous for this whole system, because if Bitcoin ends up being centralized, then essentially it means that the whole framework which provides this beauty where anyone can participate and they can have this freely independence of running their own transactions, that whole system is broken. And at the same point in time, what we are trying to say is that now your transactions can be overwritten in some, or something else can be done. So I believe, yes, we need to make protocols or a system which can prevent this thing. Now, the interesting question which you asked is like, what if a 51% attack happens, something, and can we do something beyond it? I think it's more of a research question. I think it's a bit hard um, for us to say that if such an attack happens, can we actually recover from it, or can the system still work? Or if such a centralization happen, as a person from thinking out from the CS and security background, I'll say no, we cannot proceed. We need to prevent it from even reaching there. So, yeah, so that is what my thoughts are.
We definitely, I mean, we have no precedent, so it may be a little unfair of me to be asking you, but you certainly do give us a framework by which we can think about that sort of question. Troy, you had a follow-up?
The standard Bitcoiner answer, which was, I guess, most famously articulated by Andreas Antonopoulos, is that if we have a 51% attack and we have a choice between using, let's say, OFAC compliant treasury coin, or we simply invalidate blocks from the known miners who are cooperating with the attackers and update our software, and we work off from that attack. That's the official response. And then nobody wants to use the OFAC compliant coin. This is in the old days. Now people want to use OFAC compliant coin. Doesn't really work. But and we used real Bitcoin. And I think that response is way too glib, because it abandons proof of work, essentially. If we have to decide which blocks to invalidate, we need to trust somebody. And who are we going to trust? Like some core developers or some high priests of Bitcoin to know who's like, right? Well, that gives up the whole point of Bitcoin. So I completely agree. This Bitcoiner talking point should be laid to rest. We have to prevent the 51% attack from happening. If it happened, it's pretty catastrophic. Maybe not monetarily, because maybe people are okay with soft social consensus of some form, but it's the death of something really precious about Bitcoin, which is the ability to simply look at a record and decide which one is heaviest, which chain is heaviest, and that's the valid one. We would be giving that up if we responded to a 51% attack.
And we'll come back to what can be done about it. But Matthew, if you just want to jump in. Absolutely.
Yeah, if I can add just one thing to that, which is we kind of do have a little bit of precedent for this in terms of some of the smaller proof of work currencies, many of which have faced 51% attacks. And this is really one thing that makes Bitcoin special, which is among all the proof of work currencies, Bitcoin, to my knowledge, even back to its infancy, has never, as far as we know, faced a 51% attack. And so Bitcoin, in some sense, survived or ran this very narrow gauntlet, whether by fate or by luck, which is that sort of this vicious cycle, which is why these other proof of work currencies are not worth very much, which is that the currency is not worth very much. Therefore, nobody really puts any effort into mining it. Therefore, it's susceptible to attack. Therefore, it's not worth very much. And then you kind of get this vicious cycle that's very hard to break out of it. Somehow, Bitcoin broke out of that because it has a ton of hashing power dedicated to it. Nobody has managed to successfully attack it. And so, looking at these other proof of work currencies have been attacked, they're just not worth very much. And so I think we can at least draw some conclusion from that if Bitcoin were to be attacked, it would be catastrophic to the value of Bitcoin. I don't think Bitcoin is the same if there's somebody censoring the network.
So we can either talk about what could be done about it, but I also had a follow-up based on work you've done, Matthew. So you made the case for central banks to be using Bitcoin as a reserve hedge asset in a white paper. Yeah. What I wanted to ask you was, what happens where we're in a world where, central banks they have responsibilities to their governments. They have to keep their governments afloat. What happens where we're in a world where we're mining using state resources and the incentives of the network are not transmitting the price signal the way they should be? Okay.
Yeah. So yeah, thanks for the question. I will say, so the paper you're referring to was only looking at holding Bitcoin, the asset. I wasn't looking at like state-backed Bitcoin mining, but it is a very good question. And so I do think and I think we've touched on this a little bit, but to maybe say it a little more explicitly, where the risk to Bitcoin emerges is where you have a situation where ownership of Bitcoin, the asset, is geographically divorced from Bitcoin mining. Because when you have that asymmetry, you create the potential for incentives to use the mining to seize control of Bitcoin. And so you might ask, well, why would you want to do that, right? Maybe as almost like a kind of a financial sanction. You think about, for example, the economic impact of the tariffs that the U.S. has started. It's in the probably the low trillions of dollars. I think some of the estimates I've seen, Bitcoin's in the low trillions of dollars. So the idea of like trying to destroy Bitcoin as a form of financial warfare is on par with the scale of financial, sanctions. Essentially, if you consider a tariff a form of sanction, which I think some people would. I don't know. I think it's reasonable. But it's on par with that kind of scale. And so that then gets us back into, again, something else that we touched on, which is energy, because in order for Bitcoin ownership and Bitcoin mining to not become divorced, you need there to be cheap and abundant energy in the places where people own Bitcoin. And so I think last I looked up before this panel, I think it's like 40% of Bitcoin is owned by Americans, and then Troy, you were just looking up, it's about 40% is they have the mining. So it's actually this problem doesn't seem to have emerged. Seems like ownership and mining are pretty well aligned, but whether that will continue to be the case, because the thing is, you can shift mining around the world pretty quickly. You just ship chips somewhere else. So that means that at least for the United States, we need to have some we need to have energy available to mine Bitcoin. Keeping in mind that another one of IHS's priorities is AI, right? There's a lot of demand for energy now for AI, and I was just reading about this last night that some of these newer LLM models are scaling on the order of 10x is what it takes to train them. So 10 times the computing power, 10 times the energy to get these new models. And obviously that's not going to be sustainable at some point. You can't just keep multiplying things by 10 like that. It doesn't. You will run out of resources at some point. But the kind of this demand for energy is going to be a big deal in the coming years.
Which may or may not get resolved in the market, but given the competition with AI data centers right now, there's definitely an argument to be made for what is the efficient allocation there. But since Troy has already argued about the need for decentralizing mining based on where the energy is the cheapest, we are supposed to be looking in sources outside the United States. There's companies like Gridless, for example, that are setting up and helping countries and at least organizations, villages, communities get mining underway using either hydropower or other sources of renewable energy. Could we touch a little bit upon that, Troy? Yes.
Yeah, that I sort of set out the problem of my piece earlier, but not the hopeful side. And the hopeful side, I like to do that. The hopeful side is that cheap energy, first of all, Bitcoin is driven to the cheapest energy in the world. Some of the same features that make it scale, give it efficiencies of scale, economies of scale, also push it uniquely to the cheapest energy in the world. The ability to ship Bitcoin for free wherever you are makes Bitcoin mining location agnostic, for instance. And the fact that we all use identical machines to mine and the fungibility of Bitcoin itself means you're producing a product with exactly the same market and the same cost to ship it to the market and the same cost to produce it roughly, except for energy. So energy is like 80% of the cost of producing Bitcoin. And so Bitcoin mining will inevitably be driven to the cheapest energy in the world. If you're a business that's trying to mine Bitcoin on expensive energy, you're done. And in fact, if you're just a business mining Bitcoin on energy that you have to pay anything more than marginal amounts for, your days are numbered. Because the difficulty adjustment pushes, well, basically, if you can make money on mining with expensive energy, then there's an opportunity for more people to make more money than you on cheaper energy, if such is available. And when they do, they'll drive the hash rate up, difficulty will go up, and you'll be in trouble. So that's the kind of mechanism. So first of all, Bitcoin is uniquely price sensitive, bids less for energy than any other industry in the world, because every other industry in the world is more tied to location than Bitcoin. So, and it has more inputs than just electricity. That's the input, the only input. So that's number one, is Bitcoin mining's dynamics are almost endogenous incentives are entirely dictated by energy cost, where Bitcoin mining is. And then we just look physically, it's a geographical physics question. Where is the cheap energy? And that's about where sunlight is. That's where water flows. That's where wind blows. That's where gas deposits are and coal deposits are. Where does energy come from? It comes from these natural, it all comes from the sun in some way or other, but in various forms. It's around the planet. And in particular, it's waste and free energy isn't just where energy is, but it's where energy isn't currently usable by people. Well, so, you know, if there's a lot of energy next to New York City, that doesn't matter in terms of where Bitcoin mining is, because there's demand for it. So where do you have a mismatch between supply and demand? And we see this in renewable energy. Its intermittency means there's always mismatch between supply and demand with renewable energy in terms of time of day. And we see it elsewhere with transmission of electricity is really expensive. Pipelines are really expensive. And so just also the need for heating is distributed in all Bitcoin mining. Energy is conserved as heat. Energy is neither created nor destroyed. And so in the northern climates, there's a need for heat. And we can just predict that's where hash rate will go, absent some nation state interference. And that's widely distributed and at a smaller scale than the mega data centers. Now, energy doesn't appear in gigawatt-sized chunks in nature. It is highly distributed, not just across the globe, but even within a territory. It's not located at a point, but it's spread out. That's just physical energy is just spread out. And therefore, I think Bitcoin mining will be too. I predicted even the mega mines will be in trouble eventually.
Why is that?
Well, they won't get their energy for free, because there's ultimately Bitcoin's going to be mined on basically free energy, rejected waste energy. because there's tons of that. I mean, there's 5 times as much energy being flared in flare stacks around the world as the Bitcoin mining network uses. All of that's free energy. Is it really free? No, you have to take a rig and go out there, and you have to maybe treat the gas. It's only there for a certain amount of time. You have to maintain the generator and so on. So is it exactly free? No, but unit by unit, right now we're just burning it. And unit by unit, California just puts tons of energy into the ground because it has a lot of solar, and during the middle of the day and the sunny times of year, it doesn't have the demand for that. And likewise in Texas, West Texas, everywhere we have renewables, we have just literally free energy that we're not using at all. And it's hard to find that kind of free energy at scale. And so we're going to have a competition really between the economies of scale and free or nearly free energy. That's what we're going to see play out in the marketplace. What's better, being able to sort of roll a ladder down a rack of computers to find the one that's not working, pull it down and fix it on site and put it up like you can in a mega center, or have free power, but you only have 10 machines on the site and something breaks, you got to send somebody out there. And it's intermittent, yes. Although intermittency much easier to deal with now that CapEx is depreciating much slower and the rate of improvement in computing is slowing, right? So ultimately, I think intermittency is dying off as a reason why we don't have decentralization of this radical sort now. In the future, looking at the curves, already we do have intermittent mining. We will have older machines mining on this waste energy, wherever waste energy is, and that will be the face of mining in the future. So physically, I'm not worried about it's not being distributed.
And it may be worth unpacking a little further what that market starts looking like once we realize that transmission is more expensive than generation. Everything that you mentioned about the trade-offs between economies of scale and decentralization. So what do we think the relationship is currently between the revenue models for miners? So we have paper share as a model, and you contribute a certain amount of energy and compute to the mining pool, you get paid a fixed salary. These mining pools are legal organizations, but given everything that we've considered about the availability of cheap energy and the incentives being skewed towards mining there, what could be done in terms of market arrangements between energy firms? We've touched on this a little earlier. There's the case of TEPCO in Japan, ERCOT in Texas, EPCOT rather. What could be done in terms of some market arrangements that make for more efficient allocation when it comes to the revenue models between miners and mining pools? And this is a question to nobody in particular. There's a lot to unpack there.
I mean, we're figuring this out, and Bitcoin mining is a new kind of consumer of energy. It's really new, and energy companies are taking a lot of time to figure it out. And it's also a volatile asset. It's a volatile asset that requires CapEx up front, so there's a lot of stigma attached to it. Miners are fickle consumers compared to AI data centers who will sign a contract for 10 years of power consumption, and you can count on them to use it. Bitcoiners are looking at the next 16 months. But setting that aside, looking long term, it makes sense for energy companies and Bitcoin miners to just merge into one thing, really. Energy companies know where the waste is. They have problems of transmission. Transmission is probably more than generation on your power bill now, and it is the bottleneck for us meeting the demands of energy in America is transmission. Generation is easy, transmission is really hard because of permitting, because it's complicated real world stuff to put a power line in. Meeting these repeated 10x demands is impossible for something like transmission. But Bitcoin mining doesn't need any transmission. We should really never transfer any power to a Bitcoin miner over a wire. Should always be mining right where it's produced. Use those wires for people who need wires. We don't need wires. We just use the internet to take the value away, right? So I don't ultimately think it matters what the pool structure is. I think it matters where the risk is and who can handle the variance. And for small miners, variance is really high unless they join a pool. And these payout mechanisms are all designed to help handle variance and who bears the risk of variance, right? You can either share a lot in the variance of the pool, and you can take that risk, or you can kind of buy insurance against that risk. And energy companies are really well positioned to handle a little bit of that risk actually themselves. They're masters of risk management. So I think they will have an advantage over smaller miners in that they can handle more variance and risk because they have more hedging mechanisms broadly.
You're picturing a vertically integrated model, unfortunately.
On the energy side, yeah.
The energy side, at least. Okay. Did you have a follow-up, Suyash?
Yeah. So I think I agree with a lot of things which Troy said, but I think I feel like there's another consideration which we should be taking. I mean, I definitely agree that if you have free energy, it really helps. I mean, whoever has free energy, they might be very attractive to locations where people would like to mine. Or like, for example, let's talk about Asia and Africa. They have a lot of solar energy available. I mean, the climate really supports that. But we do not see a lot of mining there. The reason being, are those economies or those people really ready to handle those things? Are those do they have such an infrastructure? So yes, free energy and can actually help decentralization, but I think it's too far to look at that. I don't think so. It's actually going to be so easy to just make it decentralized just because there is a lot of energy available. It definitely helps. It definitely helps energy companies. I agree with the part that energy companies, that other part which you said, that hey, if energy companies can use this waste energy or shale energy, which actually miners can use it, can definitely help both environment and miners itself. But I also uh, at the same point, I believe that it's not so easy just because there's an existence of energy, solar energy or water or like thermal energy, or other sources available in a lot of these countries. The Bitcoin mining will suddenly start boosting up in this country because they have several other factors. The people themselves there are not essentially ready right now to get mined because to start doing the mining. That's what I feel.
So this is a great segue into a more policy-oriented conversation.
I just have to respond to this briefly. We do have exploding mining for instance, in Africa, in a large hydro project in Kenya, massive amounts of mining expansion, and throughout the small projects as well. You already mentioned gridless. In Paraguay, we have another major public works project, minor hydro dam, where lots of miners are moving. Mining is, if you look at the rest of the kind of mining map, it's concentrated in the US, it's 38% in the US, but it is really global. And it's in places you would least expect it because in some ways, the ASIC is the unit of compute. They don't pool their computing power. Each one has a separate connection to the internet. And so the physical requirements for running an ASIC is not like AI, where you need a super clean, resilient data center. These things are run out of shacks. You can run this out of a container with just open doors on both sides in the middle of an oil field. It's super rugged, and it doesn't require really any kind of cultural infrastructure except security to keep the machines from being stolen. That's why it's sort of uniquely portable. And the reason it's in the US is because China banned it. US had deep capital markets, and people couldn't buy Bitcoin in the stock market, so they bought Bitcoin miners, and that funded Bitcoin mining companies in the US, which just needed to buy Bitcoin ASICs and mine it in a really rapid succession because the price of Bitcoin was shooting from $3,000 to $69,000. And the power price didn't matter. Once the hash rate caught up with that power price suddenly did matter. And those US equities, stock mining companies have all lost tremendous amounts of money. They're just kind of burning through cash. And mining is looking for cheap power around the world. So, I mean, I agree that it hasn't happened yet, but it is
very much happening right now that mining is pursuing the cheapest energy around the world, and AI's competition in the US is pushing some of mining out of the US as well.
So yeah, in the interest of time, I will not disagree, but I can disagree.
Right. That's great. So in the 40 or so 20 or so remaining minutes, I want to just switch track to a more policy-oriented conversation. So with all that's being said here, so we have some big pronouncements that were made in terms of the current administration saying it wants Bitcoin, or it wants to at least have, I'm not sure what the exact terminology was, but it was about nationalizing the Bitcoin ecosystem. It was about bringing mining back to the US. And I mean, yes, we may smirk or so, but what does that really do to the mining? I mean, you've touched on a lot of some of these issues, but what would be a more viable political economic narrative when it comes to some of these considerations that the current administration is making about Bitcoin? I mean, everybody, I'm sure, has their own ideas about why the current administration is very favorable to crypto, and there are obviously a lot of different stakeholders with different motivations. A lot of groups are lobbying. But overall, I mean, this is a tide that lifts all boats. There is a clear consensus that this is where financial markets are headed. We are in this new reality now, but we still have to deal with the messiness of politics. So I'm wondering if we can talk a little more about the political dynamic going on in this country and touch on what could be done in terms of keeping the nationalist tendency at bay, if at all possible.
Maybe I'll start off on that and say that instead of trying to control Bitcoin mining, I think maybe focusing our effort on how we handle like the business aspects of Bitcoin in terms of like development of second layer networks, software development. In the fiat monetary system, the US has a very, very strong control of this, right? Like money transmission around the world, like anything that touches a bank that has a branch in the US has to follow US sanctions, right? So, which, by the way, I'm not saying we should apply the sanctions to Bitcoin, but what I'm saying is, like, I think there's a lot of good to be had if software development around things like custody is done in the United States in a kind of a free and open economy, and you don't need to worry about things about issues related to like concentration of mining when it just like I'm developing a solution to custody your Bitcoin, right? And these are good businesses. They'll create jobs, and again, like having this done in an open and free society is better, I think, than having it done in other parts of the world that might have more incentives to build in backdoors, perhaps, and other more nefarious objectives for that. So yeah.
So we switched the conversation from mining to fostering an ecosystem of open source development.
Yes.
Investor economies.
Don't regulate software developers as money transmitters. That kind of stuff. Yeah, that kind of stuff. Yeah.
Totally agree with that. I think the U.S. does have an interest in having some mining in the U.S. Really, the interest in the U.S. has is nobody else getting 51% to exclude us, and I think this is hard to grok for people that our interest is in not being dominated. It's not in dominating, and for other technologies, and especially for war and military prowess. You want to reach dominance, and that provides you with security. In Bitcoin, dominance is insecurity. Dominance is killing the goose that laid the golden egg. Donald Trump has said things like, "We want all the Bitcoin to be made in America." That's really bad. There's a sweet spot between where we mine enough to know that we can get transactions onto the network and nobody can censor us, but also we are not in a position that other people in the world fear us censoring their transactions because they see us as a threat to 51% attack. And US policy should be aimed at that sweet spot. I think right now we're in that sweet spot, but I think if we grow very much in this industry in the U.S., we will be out of the sweet spot on the high side. And so policy-wise, you know, that's my concern on the mining front, that we actually build too many goodies into mining for U.S. miners and threaten the network on that side. That's
Right.
not what the mining companies are worried about. They're worried about making more profits. But if they would think long term, they would see the threat here.
Right. So if anybody had the ear of our president, it would be, don't keep the mining in the United States, but maybe keep the software developers in the United States. All right. So I wanted to leave room for Q&A. I think that might be a good point to stop. We'll start with questions in the audience here. I think we'll go Linda, Vagasha, George, and Eric. So Linda.
Thank you. I really appreciated the conversation about the use of energy or the role that energy plays in mining. So one of the things I wanted to hear your thoughts on is tech companies like Microsoft, Meta, Google, Amazon, they're entering the nuclear reactor space to support their AI data centers. And one of the goals that they have is to place the data centers, co-locate them behind the meter so that they have one uninterrupted power supply, and I guess it's cheaper because you don't have longer transmission rates. So with that in mind, I'm thinking like, well, there's a high cost to develop these nuclear reactors and a long lead time to actually putting them up and running, unless they're like decommissioned and you're like rerunning it again. So I haven't looked into it deeply, but I was wondering if in the scenario that these large tech companies start Bitcoin mining to, you know, make up for their cost in putting up these nuclear reactors, what happens if the private sector becomes the biggest hoarders of Bitcoin? Is that a good thing or a bad thing? Going back to earlier discussion about the US dollar, does that stabilize, destabilize? What are your thoughts on that scenario?
I think the question which you asked, right, it's pretty practical. We don't need, I mean, we don't need to even go to the nuclear reactor scenario. For example, Google has its own Google Cloud, or Microsoft has its own Azure platform, or Amazon has its AWS. I mean, let's say Google one day in a mind just decides that, hey, we'll use the whole cloud system to start mining. And pretty much they can. Nobody can actually stop because the cloud is there. The problem is now we have the centralization, and that is a big threat if these companies actually start they decide one day, fair day, that, hey, we want to actually use, maybe we have some downtime, maybe some Google decides that it has 10 to 12 regions, and downtime for different regions are different point of time. And during those times, they start actually using those for mining and to earn profits. Essentially, that will sort of centralize, and they have enough machines and to actually overcome and actually try to centralize if they want. That, according to me, is definitely a threat. Why they don't do it? Because I feel as of right now, their servers are pretty loaded, and they are sort of like they already have clients who are paying them enough sufficient money that they don't need any extra sort of mining industry which to be running for them. So I feel like uh, I don't think it is too practical for these industries to jump as of right now. Uh, it's hard for me to say that if they build a nuclear reactor, will there be too much of cost for them to suddenly start mining? But I feel like if they're going to do that, that's the reason they're doing it. They require too much of power to satisfy their current client and customer base. That's why they need it.
It's really quick on the nuclear thing. Bitcoin mining just pays so much less than AI per unit of energy. It's like less than 10% of what AI is willing to pay. So they wouldn't mine with that energy. They would definitely do other forms of compute, which are much more feasible. In terms of using the clouds, this is a funny thought because it takes me back to the early days when all of these Bitcoiners wrote viruses
that would steal CPU cycles. So you would download the virus, you wouldn't realize it was running, but unbeknownst to you, your cycles were being stolen, your programs weren't loading quickly, but somebody was mining Bitcoin with your cycles. But with the development of ASICs, they're just thousands and thousands of times more efficient than a CPU for mining Bitcoin, the application-specific circuits. So you would, I think, I haven't done the math, but I think all of those clouds would not compare to a single, data center, given the vast efficiencies of ASICs. Because I'm mining other kinds of cryptocurrencies that are CPU compatible or GPU compatible. GPU mining, yeah, there's a lot of GPUs you could shift to, but you're not going to mine Bitcoin with CPUs.
Okay, I do have a lot of questions, but I'll stick to one question per person. That's the minimum I can reach. I think I'll start with Suyash. Do you think it's technically possible to achieve some sort of protocol upgrade that could meaningfully reverse centralization and this threat of, centralization of mining pools? Could trust pools really achieve that level at a protocol level? And then should I go one question at a time?
So I think I'll quickly try to answer that. I think, yes, it is possible. But again, it depends on whether Bitcoin developers by themselves are ready to move to, say, version 2.0 or something else. If they are, yes, it is possible. You can actually, in fact, one of our papers that we recently published, we actually show that you can leverage the whole structure of a decentralized mining and basically make a collaborative mining, where you can still ensure that every miner is getting a payout, whether they are able to produce a valid share or not, and still the whole system by itself is decentralized. So definitely there is possibility. I do not know whether we have enough time to go over the details of the protocol, but I think we can definitely talk about. But yeah, I seriously believe that it is possible to do it. But again, it depends whether developers are ready to actually do it,
So
whether they have to move to
coordination would be a problem between the developers if that.
Yes, I think the main issue would be to adapting the current system. And I think I was talking with Troy and several other people behind the scenes. They're like, there's a lot of infrastructure goes behind the scene that we as protocol designers don't look at. And also like there's a huge amount of storage and everything. Now suddenly you're going to ask these people to move. There are a lot of practical implications which take place. So I think theoretically and even implemented, we have implementations of those open source which people can use it, but those are implementations that we have tested on like 400 or 500 machines. Will they actually scale on a large system? And scalability is not a problem, but will they actually be implemented? It's not just a simple patch. So yeah, there are a lot of factors.
Okay, this question is for Troy. So you mentioned that mining is moving towards greater sort of energy and capital intensity focused markets, right? Does that necessarily lead to fewer or more powerful actors, or can there be market design interventions to sort of stop that? And
Really interesting question here. What governments can do and what policy can do. Bitcoin's a global phenomenon. As a Bitcoin miner, your client is just the network. You don't sell your, you're rewarded by the network for finding a block. So you don't have any like customer relations, and anything governments do. So there's no like customer to act on except the network as a whole. And anything governments do with policy about mining, they can encourage it or discourage it in their province. But like, if you discourage mining where you are, it just moves elsewhere because the incentive increases as you drop hash rate. China bans mining. They had half of hash rate. They basically were a 51%. Just didn't exercise it in China. And what happened? In a couple months, Bitcoin mining was distributed around the world. So it's hard to think about structuring public policy in a way for the network because there's no world government. And every intervention is local. And in a way, Bitcoin is the best good for evading like, what do they call it? Carbon arbitrage, for instance, in in the green scene, right? You move your production elsewhere when you get banned for carbon emissions. You move your production elsewhere and ship. But when you move your production of a good elsewhere and ship, you can always block those goods coming in or add a tariff to them. But with Bitcoin, you can't add a tariff coming across the border. So the production moves away, and then it just freely comes back into your economy, right? So I kind of think what policymakers need to understand is that they don't matter. They're like pointless in this global regulation of Bitcoin. They can only, you're going to ban Bitcoin mining in New York State. Okay, you'll just send it to places that are more carbon intensive potentially. You know, you're not going to impact the total carbon emission of Bitcoin at all on the carbon front. But even on this front too, like if we try to encourage decentralization, I mean, I don't know, or good luck. The thing is its own beast.
Thank you. So George Moxery, University of Wyoming, College of Law. One of my roles at the College of Law is to be the Bitcoin and crypto person, and another of my roles there is to think about expanding the state's economy beyond energy and tourism. And so there's some overlap there. And as I'm hearing Troy speak and then speak again and speak again, you know, I mean, in a good way, because I had a question that popped up and he kept getting closer and closer to answering it, but didn't quite answer it. So I'm going to ask it, and it also has some policy implications. So in Wyoming, and really all around the world, but certainly in Wyoming and also in Montana and other places, there are thousands of oil and gas wells and coal mines that are not running because it doesn't make sense to transport the oil, the gas, or the coal to somewhere. And so some of these have been abandoned. They have environmental concerns. They have to be plugged and all of this. And on many of those, the state is bearing the burden, the cost of making them the environmental costs, basically, right? Because the bonding that took place when the mines were opened weren't enough to today cover the environmental costs, which might have gone up for other reasons and so on, right? And so somewhat of a multi-part question here. What's the feasibility of building a Bitcoin mine or an ETH mine, or well, I guess Ethereum is proof of stake now, but you know, a Bitcoin mine, let's say, or any other proof of work mine, or you know, a place that sells computing power to AI providers next to or on top of one of these mines, right? And so instead of taking the coal from 100 miles, you're taking it 100 feet. That's part one of the question. Part two, more of that's kind of for you, I think. Then there's the policy question: is should the state get involved in doing that, given that it's the de facto residual risk bearer now, and it's losing money, right, on these things because it's paying the cost of cleaning them up or plugging them or whatnot. And third, kind of a wild card: how does Wyoming's creating its own stable token come into the picture? Does that add some efficiency to all of this somehow?
Well, I'll just go after the first part, and I'll say I don't know the details of Wyoming's regulations on this, but they were one of the first states to really tackle regulation around flare gas mining, and Senator Lummis has been supportive. I don't know the details, but I know they've been very forward thinking and leading on this, and there is a lot of flare gas mining in Wyoming. And when I casually threw out this stat about how there's like 5 times as much energy burned in flaring worldwide as Bitcoin mining uses, that simplifies the reality of flare gas mining. Flare gas is a byproduct of oil drilling, and to discover gas along with the oil. And that gas often has, if it has a pipeline, you can ship it. If it doesn't have a pipeline, it's stranded. And as a gas, it's toxic. It's a local pollutant, but also it's 84 times as warming as CO2 as a greenhouse gas. And so that's why the government mandates flaring the gas. And flares burn off 99% of the CH4 and turn it into CO2, unless there's wind, in which case it can be less than 50%. Burning that gas inside of a genset, they often use these small block V8s engines, and hooked up to a generator powering Bitcoin miners.
is a much cleaner way to burn the gas because it's not subject to wind, and it converts 99% of that CH4 to CO2 in the internal combustion engine. So it's actually a benefit to the state, as well as making use of those resources. It's also an environmental benefit to the state in those cases of flaring. And Wyoming has moved on that and made it easy to do that. Capturing that's tricky. That gas has all sorts of chemical qualities. It's sour gas. It's very caustic. It destroys engines. It needs to be treated. It also has a supply curve that differs, well to well. And so not all of that can be taken advantage of in this way, but yes. So to answer your question is like, yes, it's happening, and Wyoming's a leader on it.
Yeah, so we don't even have to worry about the capture problem, right? Because it's there in the ground, we're just not taking it out because it's not worth taking it out. But if we put a mine on top, if we put a Bitcoin mine on top of the coal mine or oil mine or gas mine or well,
Yeah.
that's capturing flare gas. It's just the coal is there. Let's not bother getting it out because getting it to Casper isn't worth it, right?
Coal, okay. There's two models here. One is taking gas that's already being flared, and the other is taking stranded gas that is, it's not being flared, but it's just not next to a pipeline. And a lot of the companies that do one do the other, right? But environmentally, they're very different. And I came out of this from the environmental side. It's one thing to take gas out of the ground and burn it. It's another thing to take gas that's already being burned and just let it do some compute in addition, and put that fire inside an engine. So, but yeah, Wyoming has cases of both. Coal is different. Coal is expensive because actually burning coal and generating it just operationally more involved than gas. And so it might not be price competitive even without the element of transportation, just as you've seen the share of coal and electricity generation broadly drop over the last decade and be replaced by natural gas. That's not just environmental stuff. That's also just it's more economical to burn gas than coal over time for electricity generation. And there was in Hardin, Montana, there was a large coal burning facility that actually Marathon ran, and was the focus of a lot of critique of Bitcoin, environmental critique of Bitcoin, where they were doing exactly this. That had a lot of downtime and a lot of operational costs, and Marathon moved away from it. Partly for the criticism, but mostly because it was just operationally difficult. There are other places that are doing it in Pennsylvania on waste coal, but they get subsidized by the state of Pennsylvania to do that because waste coal is actually an environmental pollutant and they're cleaning it up. That's leftover coal, basically. So it's a case-by-case thing. It's complicated, but long story short, it is happening and probably will happen. And if you can get the tech companies to agree to run their AI data centers on coal, good luck. They're not going to like that. They're paying the kind of money that could actually revive a coal mine. And that's going to be politically explosive because of their values on the environmental front and coal burning. But economically, it makes sense for AI.
So possibly spicy question, but I think barely over 1% of the revenue that miners currently make is coming from transaction fees, like 1.29% based on an AI calculation I don't currently trust because I haven't done enough research behind it. But let's say it's 3% to be generous, and I'm comfortable saying it's probably lower than that given yearly averages. And so they're making 97% through the units of Bitcoin, but we know that that's a finite incentive. Granted, I love the incrementalism of the network's design because I think it would be catastrophic if the rewards dropped from 4 or 3 some units per block to 0 suddenly. So this is potentially less of a concern simply because it's a gradual transition. So it will be to some extent priced in. But what level of transaction fees is necessary to incentivize the use of energy that we've been describing throughout this panel? Because right now that energy makes economic sense when you're getting, 365,000 per block in terms of new units of Bitcoin and roughly 4,700 per block in terms of transaction fees. The white paper says once the new units run out, it's envisioned that the transaction fees will be sufficient to incentivize good faith mining. But to me, I'm like, that's that's a pretty, that's a several order of magnitude increase in terms of transaction fees if miners can expect to make the same amount in the future when they're no longer mining new units and probably will correctly just be called validators at that future date. But to me, is this a concern? Is this keeping Bitcoiners up at night?
Yeah, I mean, I guess the obvious answer is we don't really know yet, right? But I think my personal view on that is, this goes back to Bitcoin mining moving towards sort of like cheap or even free energy, right? If the energy to mine Bitcoin is essentially free, then you can get by on a very small transaction fee. And Bitcoin would be fine with significantly less computing power dedicated to it. What? Yeah, exactly. So like the long-term future that might end up being, yeah, you have less total computing power, but and the mining fees and the transaction fees, sorry, do go up a little bit, but it's still fine. I mean, that's again, as long if you can, it's fine if you can get the energy cheap enough to do it.
I think I agree with what Matthew said to some extent, that yes, it definitely relies on the factor of whether energy is free or not. But also, I think we can learn a little bit from Ethereum also, for the sense like it's the same challenge that it has faced. And it moved to this proof of stake model where it is not requiring as energy consumption as Bitcoin's model. But they have tremendously high gas costs to an extent that, and those gas costs are basically transaction fees. And those such high gas costs are the reason that in some sense that it's not always feasible for everyone, and basically users are competing with each other that, hey, if I pay higher transaction fees, then only my transaction will get included. So of course we cannot predict exactly what will happen in the future, but I think there will be similar challenges what Ethereum is facing due to high gas costs. And transaction fees will essentially, if transaction fees become so large, and then in some sense it will deter a lot of people. Only people who have access to a lot of money or rich people can only do it. I don't think that the actual vulnerable population will be able to use it.
Yeah, it does keep me up at night. This one is good worry. And there's bad worries and good worries about Bitcoin, and this is a really good one. Take Matthew's point that here's how I think about it. As mining goes to cheaper energy and also acts as a kind of ancillary business along with heating, you get more mining more mining out there per energy spend, more hash rate, and also it's not uniform. So if I go to attack the network, if I want to attack the network, I want to drop down a new big data center and get 51% of the hash rate. I'm not going to integrate with a town in Finland and provide them district heating. I'm going to have to pay market price for my very expensive energy. So the cost to attack the network and the cost that miners are paying could vary a lot, and that'll give us a little more breathing room. And transaction fees, in my book, they were supposed to be going up a lot already, and they're shockingly low. And then, Suyash brings up another point. What if they're not low and they go high? We did see it on Ethereum. It sucked. It really hurt the ability to transact. So it doesn't look really good either way. They have to go up a lot. If Bitcoin's going to appreciate, let's say, 100x in 20 years, and fees stay the same, we're in trouble. But if fees, because then the security budget is tiny. If the fees rise a lot, then only people who can transact on Bitcoin are large financial institutions to settle, and it's essentially Fedwire. And maybe that's okay, but it's not Satoshi's vision. Can I say that? Satoshi's idea. So yeah, it does bother me, and all the solutions to it are bad. We can once we do the quantum migration, we could take Satoshi's coins and add them to the emission schedule. I would solve the problem, but it would set a really bad precedent. Yeah, they're all bad. We could go to proof of stake. We might end up doing that if this gets bad enough. The UTXO set will live on, but many of us don't want to move to proof of stake for other precedents that sets.
I mean, I'll just say, I don't think a 10x transaction fee would be prohibitive. Yeah. And that probably gets you into the ballpark of something that keeps Bitcoin running.
Only $2.
Yeah.
I'm afraid I'm gonna have to draw our conversation to close here, but thank you so much to our panelists for I think what turned into a really interesting conversation there. Thank you all for watching on the webinar. This closes out the webinar portion. I will say you'll receive an email in your inbox at some point here with a survey. Feel free to give us feedback that helps us design better programs. If there's particular things from this that you'd be interested in hearing more about, let us know in the survey. And the other thing I'll plug is IHS has something called Scholars Edge, which is our community of scholars. So as part of registering for this, you have access to Scholars Edge. That means if there's someone here on the panel who you are interested in contacting, you can find contact information for them. You can actually find all their work there as well. The links to their papers and ways in which they might not even realize they've interacted with each other through citation networks and so on. That's all on there. And the last thing I'll mention is that just as of the last couple of months, IHS has developed its own internal AI research tools that you have access to through Scholars Edge. Some of our energy scholars have used that to track, to do energy research. There's a database of all 50 state legislatures and the federal and Congress of all the bills that have been proposed. And you can do natural language querying of basically the entirety of the legislative output of the United States through there and do some really interesting, the sort of work you would have needed a research assistant to do for you, taking hundreds of hours, can be done in minutes using our AI tools. So check that out if you get a chance as well. But with that, thank you so much, and appreciate you tuning in. And until next time, thank our panelists.